Welcome back, guys. My name is Ale, and you know what? I think it's about time that we start doing some educational videos on stock market investing for beginners in 2020. And in today's video, we're going to start things off with a basic introduction into what stocks are and how they work. I'm going to teach you guys how to actually go about buying and selling stocks in case you're someone who finds them very interesting, but you're not exactly sure how to actually buy and sell stocks. But more importantly, I'm also going to talk to you guys about valuations so that you have a basic understanding of whether a stock is considered cheap or expensive and why. And I also want to talk strategy with you guys so that you don't feel overwhelmed and you can go into the stock market with a realistic and solid game plan for long-term success without any of the BS that you typically get from other places that try to sell you like a day trading course and promise you that you'll get rich within the next couple of weeks. We're going to keep things much more realistic and honest about what to do in the stock market. So we'll cover all those different things and more, including dividends, in today's video. I hope you guys enjoy this. If you do, make sure you hit the like button. It really helps support the channel, and subscribe if you want to see more stock market related videos in the future. But with all that said, let's go ahead and just jump right into this, and let's start things off with a really quick intro into what stocks are and how they work, and then we'll transition over to valuations and strategies, and then we'll just kind of go from there. Okay, now when trying to define what stocks are, it's best to just think of them as ownership certificates that entitle you to an ownership stake in a company. And the term shares is often used interchangeably with stocks, but just to kind of simplify more, you can think of shares as the individual certificates that make up your entire stock position. I know that sounds a little confusing, but to give you an example, one might say, I own 10 shares of Facebook stock. Well, currently Facebook is trading for around $202 per share. So if you own 10 shares, then your entire stock in Facebook would be worth 10 times 202, which would be a little over $2,000 in total. And if you ever want to sell the stock, you can sell as many shares as you want, with each of them being worth about $202 each at the time of this recording. But of course, that price can go either up or down at any moment, depending on how much investors are willing to pay for it, which is usually dependent on how the underlying company is performing. Although sometimes we do see stocks go really high based on just hype more so than the actual fundamentals of the company and the business, but that's a topic for another day. In terms of how you actually make money on your investments, well, ideally the price that you initially paid would go up over time, and when you decide to sell the stock, you collect whatever profits you made from the increase in the price, and this is what we call stock price appreciation. However, there is actually another way to profit off of stocks, and this is what we call dividends, which can actually be a great way of generating extra cash flow for you and also generating some passive income as well. Now, dividends are essentially payments that a company makes out to you just for holding on to their stock, which can be very attractive to investors. Now, Facebook does not currently pay out a dividend, but another popular stock that does would be Apple, ticker symbol AAPL. And by the way, ticker symbols are just a short abbreviation that we use for identifying stocks. But let's go ahead and use seekingalpha.com to get the dividend information of Apple stock. And first up here, we can see that their dividend yield is at 1.14%. This is how much you get paid back to you on each share that you own. For example, let's say that you buy one share of Apple stock, which is priced at $270. Well, at this time, Apple will pay you back $3.08 over the next year for each of those shares that you buy, which equates to 1.14% of that stock price. And Apple divides these payments into 4 quarterly payments a year of 77 cents each. Now, this is generally considered a pretty small dividend, but the great thing about Apple's dividend is that it has a lot of potential to grow and get bigger in the future, which is great for what is known as dividend growth investing, which is actually a strategy that I've been focusing more on lately myself. See, over time, that dividend will likely get larger and larger, and assuming that the company doesn't go through a major hardship that would force them to have to cut their dividend, you could potentially be getting paid out a huge dividend every quarter well into the future, and possibly even into retirement, which can be a great source of recurring income. Now, I did make an entire and in-depth video on this type of strategy. So if you want to learn more, I'll link it for you down in the description below, but I'll just quickly cover the last three metrics that are shown here, as that gives you a decent idea of what the dividend's growth potential is for the future. And these three metrics are the payout ratio, the 5-year growth rate, and the growth history. Now, the payout ratio tells you how much of the company's profits are being paid out in dividends, and the lower that the ratio is, the more sustainable the dividend is as well, and can therefore be increased in the future. So I always look for a payout ratio of around 50% or less in my dividend growth stocks, and in Apple's case, at around 23%, they have a very sustainable dividend. They also have a 5-year growth rate of over 10%, which means that they've increased that dividend by over 10% on average over the past 5 years. And anything above 10%, I generally consider that to be pretty good. And then for the growth history, they've only increased it for the past 7 years in a row. And generally, I do like that number to be larger. But in Apple's case, I believe that this was when they actually started paying the dividend in the first place. So I give them a pass on that, since they've essentially grown their dividend every year in a row since they started paying one, if I'm remembering correctly, but I'm not 100% sure. Anyway, I'd say that Apple is actually a pretty good dividend growth stock, not to mention that they also have an amazing balance sheet. But if you want to learn more about balance sheets, I'll leave you another link down in the description to one of my balance sheet videos, which is also very important for stock market investing. But as you can see here, Apple does have over $100 billion in cash and over $160 billion in current assets, which helps them cover all of their short-term debt. So they do have the funds to keep paying their dividend, paying off their debt, and keep investing in the company. Although I do think that their long-term debt is too high and they should really work on reducing it. But again, just watch that video if you want to learn more about balance sheets. Anyway, now that we have a basic understanding of how stocks and dividends work, let's now talk about valuation so that you know whether a stock is considered cheap or expensive. And we'll also talk a little bit about strategy as well, so that you have an actual game plan when entering the stock market. Now, one thing that really frustrates me is when I get comments from people that honestly just don't know any better, and they say things like, hey, this stock price is really low compared to these other ones, so that means that it must be really cheap and undervalued, and so it's a great buy right now. Or they'll say things like, hey, this other stock is super expensive, it's like the stock price is really high, which means that it's really expensive and it's overvalued, and nobody should be buying that stock. But let me just say this right now, the individual share prices, first of all, 100% subjective, because what is low to you may not be low to me. And number two is that it has absolutely nothing to do with the actual valuation of the stock. A stock with a price of $5 a share can still be incredibly overvalued and considered expensive, while a stock with a share price of $100 can still be incredibly undervalued and be considered quote unquote cheap. What really matters is what you're getting in return for the price that you're paying. And to determine this, we have to actually value the stock. Now, there are many ways to value a stock, and just like before, I will have to refer you to another video I made where I go much more in depth on how to actually value stocks. And I know that this kind of sounds like I'm trying to force you guys to watch some of my videos, but the thing is that this video would be insanely long if I went that far in depth on every subject. So I'm just trying to give you like a basic overview here, and then if you want to learn more, and go more in depth and watch some more advanced videos, then you can find those down in the description. But just to keep things simple, some of the things that you have to take into consideration when trying to value a stock is how good the company is, how strong their brand and products are, how their business is performing, and how much they're expected to grow in the future. I know that sounds like a lot of research that you need to do, and to be honest, it is, but you really should do it, because if you want to be a successful stock market investor, this is something that is very important. But just to illustrate my point about whether a stock is cheap or expensive, let's compare Facebook stock to Apple stock. Now, Apple stock trades for a much higher share price of $270 per share, so about $70 more than Facebook. And because of that, a lot of people who just don't know any better would automatically assume that Facebook stock is much cheaper and is therefore a better stock to buy. But if you actually look at the PE ratio, the price to earnings ratio, which is one of the most popular valuation metrics out there that tells us how profitable a company is in relation to the price that we're paying paying for the stock, we can actually see that Apple has a lower PE ratio, meaning that they are more profitable for the price that you're paying per share and is therefore a better value. Now, to be clear, the PE ratio is just one tiny little piece of the giant puzzle. So again, you need to watch my how to value stocks video to understand all of this, but this is just to show you that a stock with a lower share price doesn't necessarily mean that it's cheaper when you factor other things in, like how profitable the company is in relation to the price that you pay. So while you technically do pay more money for Apple stock, it can be argued that you ultimately get more value back in return and is therefore a better deal. However, there's one more thing that I need to mention here, and that's that sometimes a stock will trade for a higher PE ratio because they may actually have a better business that is expected to see more growth in the future. Now, there are absolutely exceptions to this, but in this particular case, Facebook versus Apple actually does prove this point pretty well. If we look at sales growth for the fiscal year, Facebook is expected to grow at 26%, while Apple will only see growth of about 6%. And even the following year, Facebook will still be north of 20%, while Apple will be at less than 8%. And of course, EPS or earnings per share growth is what really matters for PE ratios. But even here, Facebook will see growth of over 20% a year on average over the next 5 years, while Apple will be at less than 10%. So clearly Facebook has the higher growth, and therefore it may be justified that they are more expensive on a PE basis despite having a lower share price. This is ultimately the argument that is made between value investing and growth investing. Ideally, you would want to have a healthy balance of both strategies, but I do admit that I lean much more heavily towards growth investing myself because I'm still relatively young and I therefore care more about how much these companies will grow over the longer term. Which brings me to strategy. In my opinion, long-term investing is a much safer strategy than short-term trading, especially for beginners. I can't tell you guys how many times I've seen people buy stock, see it drop over the next couple weeks or months, get infuriated because they have this unrealistic idea that stocks need to always be climbing and going up no matter what, and then proceed to selling their stock oftentimes for a loss, and then call stock market investing a scam and never touch a stock ever again. And I know this from personal experience with friends and family that have literally done exactly that. So let me just tell you guys right now that anything can happen in the stock market, but as long as you do your homework and you follow a solid long-term game plan, you will most likely be a very successful investor as long as you keep your expectations within the realm of reality. And while there's really no way that I can tell you everything that you need to know within the next 5 minutes, what I can do is I can tell you to be patient, be willing to learn, and work on developing your strategy out over time. And if you need a place to start, I'll give you 5 tips right now that you can take action on. Number 1, if you're a beginner in the stock market, stick to larger profitable companies that you actually know a lot about yourself. For example, when I first set up my girlfriend's portfolio, the 2 stocks that I built her entire portfolio around were Amazon and Apple because I knew that she shops on Amazon a lot and she uses almost every product that Apple makes. Do this so that it's easier for you to understand the company's products, their business, and their competition. Number 2, valuations matter. Again, watch my valuations video. Don't just buy a stock because you think that the company is awesome. That's only a place to start, but you need to actually value the stock. For example, tons of people flooded into Beyond Meat stock, which is a company that makes alternatives to meat products, because they thought that it was so cool and disruptive, and without paying any attention to the ridiculous valuation as the stock climbed to very high levels, and it later ended up crashing by over 50% over just the past 3 months alone. Number 3, stick to long-term investing over short-term trading. Long-term investing ensures that you can ignore short-term noise. It'll help keep you calm and it'll keep your mind on the long-term picture. For example, my largest stock is currently Microsoft, and because I believe in their future so much, after having done so much research on them, I know that if they ever drop over the short term, it's just a buying opportunity for me to add to my position and lower my cost basis. By the way, cost basis is just a term that we use to refer to the average price that we paid for our stock over time. Anyway, if you do too much short-term trading, you'll likely not only lose a ton of money, but you'll also be stressed out and you won't even enjoy investing in stocks in the first place. Which brings me to number 4, and that is to have fun. Enjoy investing in stocks. In my experience, the ones that hate stock market investing and look at all of the work and research as a chore are the ones that ultimately fail and make the most mistakes. If you enjoy learning about stocks and companies, then you're much more likely to go the extra mile, do the extra research, and ultimately set yourself up for much greater success. And finally, number 5, be careful, diversify, and don't do anything that you don't feel comfortable with, but also don't be afraid to make mistakes. If you missed the boat on a stock because you didn't think that it was a good deal at the time, that's okay. There will be other opportunities in the future. And if you lose money on a stock, guess what? We all make mistakes and lose money sometimes in the market. If it was super easy to predict everything with 100% accuracy, we'd all be filthy rich. But the reality is that we all make mistakes. So do your best to keep the mistakes to a minimum by sticking to your investing principles that you will develop over time, and work on diversifying your portfolio so that you're not overly exposed to any one stock or mistake. Now, there's no right or wrong amount of stocks to hold at any particular time, but I can tell you from experience that the people who put all of their money into just one stock are usually the ones that end up losing everything because they have a sort of gambler's mentality and just want to instantly become rich without being patient. Spread your money out into several stocks, and that way, if one of your stocks happens to crash, it won't completely ruin you. Again, there's no right or wrong number here, but I generally like to hold around 10 stocks at a time, but this is also something that you will build on over time. If you want to start out with only a couple of bigger, safer, and more reliable stocks to practice and kind of get the hang of everything with, then I don't really see any problem with that. And by the way, there's also something called ETFs. These are kind of like portfolios that are sort of set up automatically for you. They usually just track like the broader market, but these are useful for just kind of investing in the stock market without having to do a lot of like research yourself. It's just kind of a way of being invested. That's not really what we focus on in this channel. We focus more on doing the actual research and picking stocks individually, but just know that ETFs are out there. And I'll even leave you another video down in the description in case you want to learn more about ETFs. I did make a video on that a while back. Okay, and finally, I just want to finish up here by explaining to you guys how to actually buy and sell stocks. Now, there are many different brokers and platforms that you can use, and most of them are generally considered fine. A lot of the popular ones would be things like E-Trade or Charles Schwab or Fidelity, or even smaller brokers like Robinhood and M1 Finance. Again, all of these are generally considered fine. I believe all of them also offer commission-free trading at this time, which is great because it means that you can buy and sell stocks without having to actually pay like any kind of little fee. So all you have to do is really just pay for the stock itself, and that's basically it. But in my opinion, if you're a beginner in the stock market, the easiest platform that I think is the one to use is probably Robinhood, because all you have to do is just download an app. It's very, like, the user interface is very simple, it's very minimalistic, and it guides you through everything. You basically link your savings or checking account, you deposit some money, and you're good to go. All you do is search for a stock, click on buy or sell, enter the amount of shares, and that's basically it. And at the end of the year, you can download your tax form and use that to do your taxes, and it's all just very simple. Also, the other thing that I really like about Robinhood that they literally just announced, like today I was working on this video and I saw that they just announced it, is that they're going to be adding fractional shares in the very near future, which is great for those of us that have like smaller budgets. Like, for example, say you want to buy Amazon stock. Well, Amazon currently trades for close to $2,000 a share. Well, if you have a small budget and you can't really afford that much money like per share, which I completely understand, well, you'll be able to buy, say, just $100 of Amazon stock. And what Robinhood will do is they'll just give you like a fraction of that share. They'll give you a piece of it, and that's what you'll own. So it's a great way for people to be able to buy some of these giant companies with very high stock prices, share prices, and still be able to own the companies and buy them in like small amounts. And by the way, I'm actually someone who likes to buy stocks in small amounts as it is. And especially if you're a beginner, buying in small amounts over time can actually be a great way of minimizing some of your mistakes. Like if you're making a lot of mistakes constantly, if you're owning fractional shares, there'll be much smaller mistakes that you'll be making. So you can just kind of buy slowly in small amounts over time as you gain more experience and become more comfortable in the stock market. And then you can kind of increase your buying once you have more experience. And I wouldn't consider myself a beginner, but I like to use fractional shares because I like to buy stocks when they're actually going down and kind of average my buying all the way down. So I like to do that like in small amounts. I don't like to buy big positions as the stock is going down, but that's more of like an advanced topic. I don't want to get into that right now. Anyway, I think that just about covers a lot of the basics that we needed to cover in this video. And again, I'll leave you links to some other educational videos down in the description if you want to go a little bit more in depth. But if you have any questions, make sure you leave them down in the comment section. I'll try to respond to a lot of them. And we also have a lot of viewers that generally respond to them as well and try to help you also, which is really cool. But anyway, I hope you guys enjoyed the video. And if you did, make sure you hit the like button, really helps support the channel. And make sure you subscribe for more videos in the future. But with all that said, I'll catch you guys in the next one. Take care. Bye-bye.